Thanks for joining me this Friday, the 31st of October, for my last weekly wrap for just a little while as I head off on maternity leave until 2026. I'm Grady Wulff, Senior Market Analyst with Bell Direct. Has the AI rally really run out of steam, or is the train just leaving the station? This week we had 5 of the Magnificent 7 post results, giving clear indication that this AI revolution is well and truly underpinning earnings growth, and there is really no slowing down of expansion potential anytime soon. Let's dive into 3 of the big names of the Magnificent 7 that released results this week, what the market reactions were to the results, as well as what picture is being painted about the growth of AI. Microsoft kicked off FY26 with another standout quarter, comfortably beating Wall Street expectations as its cloud and AI strategy continue to pay off. Revenue surged 18% to $77.7 billion while operating income rose 24% to $38 billion. The results underscored the strength of its intelligent cloud division, especially Azure, which is proving to be the backbone of Microsoft's growth. AI adoption across its ecosystem, from enterprise copilots to cloud infrastructure, has driven real demand and expanding margins. Management struck an upbeat tone, with CEO Satya Nadella calling Microsoft a planet-scale cloud and AI factory. And CFO Amy Hood noted momentum across productivity and consumer segments. Despite a softer tech environment for consumers, Microsoft's breadth positions it uniquely to capture structural growth in AI while maintaining disciplined profitability. Shares fell after hours though, as investors reacted to a capex jump to $34.9 billion from $24 billion in the last quarter, reflecting continued heavy investment in AI capacity. Alphabet's third quarter results reaffirmed that its AI and cloud strategy is gaining serious traction, with revenue up 16% year on year to $102.35 billion and profit comfortably topping expectations. The revenue results saw Google's parent company surpass $100 billion in the quarter for the first time, thanks to growth in search, AI, and cloud capabilities. The standout performer was Google Cloud, which surged 34%, underscoring accelerating enterprise demand for AI-driven infrastructure and analytics. Strength also flowed through to core advertising, YouTube and search, where the integration of generative AI tools have enhanced engagement and monetization. Management's focus on deploying AI across every layer of the business, from products to platform, is translating into a clear competitive edge and renewed growth momentum. The market responded decisively, with Alphabet shares climbing around 6% in after-hours trade as investors welcome signs that the company's pivot towards scalable AI and cloud solutions is broadening its growth profile well beyond the traditional advertising engine. Meta's Q3 results were mixed and sparked an 8% sell-off in after-hours trade on Wednesday this week, amid a major tax bill hurting EPS and a multi-billion-dollar hiring spree to bolster AI expansion, which hurt the margins of the social media giant. The social media giant delivered an impressive quarter though on the surface, with revenue jumping 26% year on year to $51.24 billion, comfortably beating Wall Street expectations and highlighting continued strength across its advertising and Reels platforms, alongside early benefits from AI-driven engagement. However, the market reaction told a different story, with shares sliding in after-hours trade as investors digested a $15.9 billion one-off tax charge and a sharp increase in AI-related hiring and infrastructure spend that weighed on profitability. While CEO Mark Zuckerberg reaffirmed Meta's long-term commitment to building the AI platform that's leading, the company's outlook pointed to higher expenses and capex in the coming quarters, reflecting its rapid build-out of AI data centers and model development. The result is a mixed investor narrative: strong operational momentum and clear strategic vision, but near-term profit pressure that's testing the patience of Meta as it shifts from social media dominance to AI platform leadership. So, from an investor's point of view and perspective, what overall picture is being painted about the AI thematic in markets? There is clearly solid headroom for growth in earnings on the back of AI expansion, despite significant spend in the space eating into margin expansion this results period. Profit growth is a longer-term focus across the Magnificent Seven, as a higher capex this quarter will be used to bolster AI offerings in a bid to deliver meaningful margin appreciation for many years to come. Locally, from Monday to Thursday, the ASX 200 posted a 1.63% loss as healthcare stocks plummeted 9.56%, weighed down by sector heavyweight CSL were tanking this week on a trading update and demerger delays. The winning stocks were led by Domino's Pizza, soaring over 17% on takeover rumours, while AUB Group and Nick Scali rose over 15% each this week. And on the losing end, Lynas Rare Earths fell 22.97%, while CSL and WiseTech Global ended the week down 17.4% and 15.01% respectively. On the broader market index, the All Ords posted a 1.61% decline as Arafura Rare Earths tumbled over 39%, which offset IKE GPS Group's more than 28% rise. The most traded stocks by Bell Direct clients this week were BHP, Tasme PLS, Eagers Automotive and L1 Group. Clients also bought into CSL, WiseTech Global and LGI, while taking profits from CBA and Lynas Rare Earths. And the most traded ETFs by our clients this week were led by iShares S&P 500 AUD ETF, Vanguard Australian Shares Index ETF, and Vanguard MSCI Index International Shares ETF. Next week, we may see investors react to the RBA's latest rate decision locally, where the market is now expecting Australia's central bank to hold rates given the latest CPI print uptick. While overseas, key US jobs data and key Chinese trade balance data are released later next week, which will give an insight into how the world's two largest economies fared over the last few months. And that's all for this Friday, and from me for just a little while. I can't wait to see you in the new year, and as always, happy investing.